Now, the second part of sentiment that we're going to touch on is public opinion and news. So, what are non-traders saying? This is an important question to ask yourself. What's the media's narrative? What is the public's narrative? At market tops, you're going to tend to see everyone buying stocks and quote unquote getting rich. And at market bottoms, you're going to see the exact opposite. Everyone absolutely hates the market. And this is a pretty funny picture. This happens a lot on CNBC. We get something I call models and bottles, baby, on the NYSE floor and the New York Stock Exchange floor. And when stuff's going good, we tend to see a lot of this stuff, this pizzazz, it gets really over the top. And when we're crashing and near a market bottom, we get stuff like this. This poor Chinese woman, she not doing too well in the market. And these are the types of images that you'll get from the media when we are selling off hard and possibly near the end of a bear trend. So why do we want to kind of stay in tune with all this? It's going to inform a macro trader the potential turning point in trend. Because at trends, there are always emotional extremes. Now, most people remember the NASDAQ99.com bubble. And what happened was, we went basically parabolic from 90 to 99 straight up. And on this way up near the top here, everyone thought they were a professional day trader. Everyone was making millions off of stocks. They thought they could quit their job. The best thing that ever happened to them. And of course, right when everyone thinks that, we go straight down. All right. And then at the bottom, everyone thinks that the market's the worst thing that happened to them. They're never going to play in the market again, etc. And then we rip out and go straight up. And the same thing happened in '08, guys. People thought that the market was over. They're never investing again. The point of maximum depression. And at that point, markets are very prone to reverse and go higher. So this is definitely something you want to be aware of, is what is the public's mood. And when it gets very, very extreme is the most important, okay? You don't need to look at every single headline in news, but when you see extreme headlines, that's something to tune into. Now, when we're talking about news, what's really important is the reaction to the news. All right, not as much of what the news is from a sentiment standpoint. So bull markets are going to rub off bad news. They're going to be going up. If bad news comes out, they might sell off really quickly but rebound. They're not really going to care. Bear markets are going to do the opposite. All right, they're going to ignore good news. So if they're downtrending and some good news comes out, they're going to go up and not respond too well to them. All right, so it's going to sell off still, even though it's good news. So noticing these key disparities between what the news is and what price is doing is important. And when we see things like this, which I'll explain in a minute, where price reacts the opposite of what you respect, that's also a very key indicator after a news release happens. So this is USD dollar, Japanese yen. And what happens with this chart is as this price goes up, that means the Japanese yen is getting weaker. Just to clarify that here. Okay. And so what happened was the Central Bank of Japan came out with something called NIRP, which is negative interest rate policy. You don't need to know exactly what that means, but the basic relationship is as follows. Japan lowered their interest rates from basically 0 to negative. And usually in response to that, your currency should weaken. Okay? And it did that. This was the announcement, and it did that right off the bat. But then look what happened. The currency rapidly strengthened and sold way off. And remember now, this is the yen weakens as it goes up and strengthens as it goes down. So we rapidly sold off and did something that the news would not suggest at all. So this is a big key indicator, right? We had news that came out that said this chart should go up. Instead, we massively sold off. And then look, price continued to trend in that direction. This indicated that a new trend had started. So that's it for section 6 on sentiment. And here are the takeaways. Positioning reports can be used to see if trades are crowded or not. So we talked about COT reports, we talked about 13F, and we want to be aware of where the big players are positioned so we don't fall prey to sometimes a crowded trade like a hedge fund hotel where the carpet could be pulled right out from under us. Then we learned about how reaction to the news is more critical than the news itself. So we want to see the news come out, and if it's good news, the price should go up a lot. If it doesn't, and price actually reverses and goes down, then that means there's a potential trend change occurring in the market. All right, and then Another one that I don't have listed here, but we also talked about was the emotions of the market. When we see extreme emotions, very, very extreme, that's usually indicative of a top or a bottom. And so before we wrap this section up, remember sentiment is the most important or advanced part of the market's trifecta. Not important, advanced part of the market's trifecta. And it's not a big deal for beginners. So if this seems a little confusing, don't worry about it. You can still succeed with just knowing fundamentals and technicals, and then you can add the sentiment analysis on later to juice returns.